Hi there. Today I was going to take you for a little walk outside and discuss understanding IRR for real estate, but we just started getting a little bit of a downpour here, so I decided I was going to stay inside for this one to discuss internal rates of return. Now, internal rates of return, or IRR, basically financial calculations that evaluate the expected annualized return over a given time period. The calculation includes the initial cash equity invested in a particular project. It also takes into consideration the ongoing cash flows from time perspective over the hold period, and then the ultimate proceeds upon the asset disposition and or refinance. So it really does take into consideration all the cash flows that you receive back as an investor. Now, as an example, let's assume that we're buying a $4 million property and we're investing $1 million of cash equity. So we have a 75% loan to value. And during our hold period, over a 5-year hold, we get a 5% cash on cash return. So that 5% would be $50,000 a year. And we get that over a 5-year period. Let's just assume that there's no growth. That means from a cash flow perspective, we get $250,000 of cash flow over our 5-year hold. At the end of our 5-year hold, we sell the property and we get back our original $1 million, and let's say that we've had some profit as well, and our profit after cost is another $250,000. So if you look at it on an IRR basis over that 5-year hold, we are going to be getting a 10% IRR. And the way that's calculated is we initially put in $1 million, we get back $50,000 in year 1, in year 2, in year 3, in year 4, in year 5. And then in year 5, we also get back our $1 million of original equity plus the $250,000 of profit. So over the time period, we've made $500,000. And over that 10-year period, the IRR would work out to be about 10%, because 500,000 divided by our $1 million is 50%. You divide that by 5 years, that works out to about 10%. Now, the IRR is going to work out to be plus or minus 10%. It's going to be it's a little bit more scientific than what I'm doing, but that's a rough rule of thumb. Is if you've made a 50% return on your money over that 5-year period, then you get about a 10% IRR. Now let's use the same example where we have a $4 million property and we invested $1 million. We still have a 5-year hold period, so we're at 75% LTV, 25% cash equity. But now let's assume that over that time period, we actually made a 10% cash on cash return. So we get now $100,000 a year over that 5-year period. So we've made $500,000 from cash flow. At the end of our 5-year hold, we sell the property and we get our original $1 million back, plus we get another $500,000 back. So now we have $500,000 of cash flow, we have $500,000 of profit that comes at the end of the year, so we've made $1 million on our $1 million. Now, so we get back $2 million less our original $1 million equity invested, so we've made $1 million. Divide that by our 5 years, and what we have on that is a 20% return. And so the 20% return equates to about a 20% IRR. We were getting 10% from cash flow and another 10% annually effectively from the profit upon the ultimate sale of the property. So that's how IRR generally works for real estate investments. I use IRR mostly in an Excel model, but I do rough rule of thumbs for IRR all the time. It also works well when you're calculating in an equity multiple, because then you can subtract it off and figure out what your annualized return is as well. So I hope you enjoyed this video on understanding IRR for real estate investments. If you have any questions or you want to dive deeper on the topic, feel free to let us know and we can do that. Thanks so much, and we'll look forward to seeing you on the next video.